This chart shows a 5% spike in the stock price of one of Europe's oldest industrial giants. That surge pushed them to the top of the FTSE 100, driven by a £4.9 billion operating profit forecast. But when you hear that name, you likely picture leather seats and hood ornaments. The entity responsible for this windfall doesn't make luxury cars. They are actually an aerospace and defense manufacturer. Their output is heavy engineering. They build commercial jet engines for long-haul flights, turbines for nuclear submarines, and systems for industrial power generation. Hardware manufacturing is capital-intensive, requiring massive factories and decades of research. It is rare for a legacy firm in this sector to post a 46% jump in profit growth, performance usually associated with software. This ledger breaks down performance for the first half of 2026. Revenue grew 26% to £11.2 billion, driving a 41% spike in earnings per share. Underlying operating profit rose 46% year-over-year to £2.5 billion. This profitability is shifting the company's financial structure. While heavy manufacturing typically requires high debt to fund production, they have accumulated a net cash position of £2.1 billion. The company uses this liquidity for shareholder returns, executing a £2.5 billion share buyback program. These improvements led to a credit rating upgrade to A-. By clearing debt and accumulating billions in financial reserves, this industrial manufacturer has transitioned into a self-funding business. These financial results are tied to a shift in global security. High international tensions led allied nations to commit to multi-year increases in defense spending. This momentum is visible across the sector. BAE Systems also upgraded its profit forecasts by up to 12%. Governments are ordering hardware to modernize their militaries, creating demand for everything from armored tanks to the THAAD interceptor missiles shown here. Rolls-Royce builds the propulsion systems for these platforms. A core driver of their future revenue is the UK's Defence Investment Plan, which funds advanced engines for next-generation hardware like the Tempest stealth fighter. Volatility has shifted the pace of UK defense manufacturing, creating a period of high-growth profitability. The Power Systems division is now scaling as a secondary growth vector, distinct from traditional defense contracts. These industrial gas turbines are seeing increased demand from AI companies in the US. These firms require the reliable, high-capacity power generation these units provide to run large-scale data centers. They are moving into autonomous warfare. The Brotenax is a jet-powered, uncrewed stealth drone flying alongside human pilots. Rolls-Royce develops the engine for this project. Expansion is also underway in the energy sector. They're small modular nuclear reactors. The company has secured contracts and selection status for these units in the UK, Sweden, and the Czech Republic. By supplying the hardware needed for AI power and autonomous weapons, the company is diversifying its revenue streams beyond current geopolitical trends. This data show how these catalysts have impacted the company's bottom line. Operating margins in civil aerospace, defense, and power systems have all climbed above 20%. Civil aerospace margins are supported by the return of long-haul passenger flights, which has increased the demand for civilian engine maintenance and parts. These results follow the transformation strategy initiated by CEO Tufan Ergin-Bilgic in 2023. His focus on internal efficiency and contract renegotiation is now reflected across the entire portfolio. This performance led the company to raise its full-year free cash flow forecast to £4 billion. The company has calibrated its divisions to capture the growth in AI infrastructure, global rearmament, and long-haul travel. What companies should we analyze next?